What is a market in economics? In economics, a market refers to a space, physical or virtual, where exchanges of goods, services, or resources take place between buyers and sellers. Markets do not necessarily have to be physical locations. They can be online platforms, such as e-commerce websites, or even informal markets, such as street markets. The market is fundamental to market economies, as it is the primary mechanism through which the prices and quantity of goods and services produced and consumed in an economy are determined. There are several types of markets, depending on what is exchanged or how they are organized. 1. Markets for goods and services. These are those in which products and services are exchanged. For example, the market for food, clothing, technology, etc. 2. Markets for factors of production. These are markets where the resources needed to produce goods and services are exchanged, such as the labor market, workers, the capital market, money for investments, and the land market, land or natural resources. 3. Labor markets. In this market, workers supply their labor, and companies demand labor to carry out their productive activities. 4. Financial markets. These are markets where financial assets, such as stocks, bonds, or currencies, are exchanged. Examples of these are the stock market or foreign exchange markets. How do markets work? In a market, buyers and sellers interact to agree on a price in exchange for goods or services. Prices are determined by the law of supply and demand. When supply and demand are balanced, the market price and the quantity of products to be exchanged at that price are established. Types of markets by competition. 1. Perfect competition. This is an idealized market where there are many buyers and sellers, none of whom can influence the price. Products are homogeneous, meaning all products are identical, and information is perfectly accessible to all. 2. Monopoly. This is a market in which a single producer controls the supply of a good or service, giving them the power to set prices without competition. 3. Oligopoly. In this type of market, a few sellers dominate the supply of a good or service, giving them some power to influence prices. 4. Monopolistic competition. This is a market with many sellers offering differentiated products, e.g., clothing or restaurants, giving them some control over the price due to product differentiation. Markets allow scarce resources to be allocated efficiently. They facilitate the exchange of goods and services, allow for specialization, and provide signals to producers and consumers about what should be produced and in what quantity, all based on society's preferences and needs.